Hello everyone, today is Friday, June 3rd, 2022. My name is Evan. Welcome back to another edition of Stock Market Weekly presented by the Trade Risk, where it is our job to break down the most important trends, price action, noteworthy moves across financial markets. If you're brand new to this video series, welcome. Thanks for being here. Here's how these videos work. We break up our analysis into two parts. In part one, we look at everything that went on this week in markets beyond price action. We look at interest rates, we look at volatility, the term structure, we look at correlations, pick apart things that look interesting or notable. And then in part two, we jump into the charts. We take a closer look at price action and market trends and try and best position ourselves looking ahead. So hopefully that sounds good to you. Hopefully you're in the right place. Let's dive into some of what we're going to be covering in this week's episode. So big sort of story front and center is no immediate stock market follow through. What do I mean by that? Well, we had our first big up week. We had our first up week last week where markets rallied pretty darn hard, but we did not get that immediate follow through buying pressure this week. It was a holiday shortened week. Markets did hold up reasonably well given the fact that they rallied last week, but they did not add on to more gains. We did see the VIX drop down to roughly 1 month lows. We also had a bunch of headlines come out in the second half of this week, basically from some of the big tech companies and other companies in general. But we had things like Microsoft lowering the fourth quarter guidance, which put a little bit of pressure, panic selling a little bit on Microsoft stock. It mostly got bought up on Thursday. And then on Friday here, we see that Tesla's cutting 10% of its workforce with sort of the uncertainty that's ahead. It seems like it's trying to be fiscally responsible here. So these are the types of headlines that the market is grappling with right now in this market environment. We're also going to be looking at some cycle analysis, and we're going to be looking at some of the most important short-term levels that I'm paying attention to. So let's dive right in. First things first on performance. You can see on the right-hand column here, this is the 1 week performance. So it was a short week, 4 trading sessions, but we had basically red across the board, S&P 500 down and Nasdaq down basically 1%. The Russell 2000 faring a bit better this week. In fact, it tried to push green, it tried to hold green, but it couldn't quite do it. World stocks also doing pretty well out there. But generally speaking here, you can see negative on the week. If we take a look at trends, we break trends up, just very simple here. We've got a short-term trend, we've got a medium-term trend, we've got a long-term trend. You can see both the long and medium-term trends. Just looking at the 250 SMA, whether or not they're declining or advancing, they're both declining. That's not new. So I think we all sort of know that. We know the type of environment we're in. We are still seeing this counter trend rally though stay in place, right? Even though we did decline a bit this week, we still have a 2-week moving average here rising in all of the US indices. So we do have this nice sort of bounce still happening. If we take a look at volatility this week, as we talked about at the top of the video, we did get the VIX down at 1 month lows. You can see it did close down from last Friday's levels. So 25, 23, we were trading underneath 25 for a couple of days this week, but ultimately went out over 25. Still moving in the right direction, volatility down. There's not a lot of demand for volatility right here. We're going to look at VIX and VVIX later in part 2 of this video, and you'll see what I'm talking about there. Nasdaq vol was up just slightly, but basically break even or, mostly flat here in terms of VIX volatility. Our drawdown monitor, not a whole lot changed here. So this is the same exact levels we looked at last week. I mean, we had a little bit of change, of course, but still we're approximately 20 to 25% down. Well, I shouldn't say that. We're only 14.71% down in the S&P 500 from its 52-week highs, from its all-time highs. But the Nasdaq and the Russell are down approximately 25% from those peaks that we saw just about 5 months ago. All right, now here's a new one. This is the Fear and Greed Index. This is, I believe, published by CNN. I don't put a whole lot of emphasis on this. I don't necessarily even watch this closely, but I thought anecdotally it'll at least be interesting to include here. We have moved up slightly, so going from the extreme fear into the fear category here. But basically what I'd like to illustrate here, or just again paint the overall picture, because it's easy to get lost in the weeds of all the TA and all the short-term time intervals of markets, is that broadly speaking, this market is still pretty hated out there from a sentiment perspective. And there's tons of different surveys. There's lots of ways to look at it. You can look at put call ratios. You can get certainly more sophisticated. But the point is that this market, even though it has experienced a short-term rally, and even though some of those short-term trends are starting to point up, it is still a hated market for the most part. And I think that's pretty clear even just anecdotally from social media and so on. I also wanted to include I'm trying to include, so, I want to include more output work from other traders, and I mean, I guess even news sources or surveys like we just looked at with the Fear and Greed Index. But this is a video I happened to catch the other day with Larry Williams on Stock Charts TV, Stock Charts YouTube channel, which Larry Williams, if you're not familiar with him, legendary trader, really respect his work. And, I just am a fan of his in general. But he was talking about cycles. He does a lot of work on cycles, and his cycle research, his cycle analysis has us sort of bottoming out here in the market around this time frame. So basically around June is when he was expecting that stock market low. Coincidentally, that's basically when we sort of bottomed out in the market. And he's actually looking for a meaningful low and sort of a lift up here and a rally into August. Again, I'm not going to build a trading strategy. I'm not saying just buy everything and go, long until August. I just want to present some of the other evidence, some of the other research from other traders that I respect. So it's something to think about. There's obviously a lot more info. You could catch the URL in the bottom left there. Go to Larry Williams' website, and you could check out more there. I don't subscribe. I'm not a paying endorsement whatsoever or anything like that. 52-week highs and lows. So this is our market internals research here that we track every single day. And you can see this week, notably here, and this is important, that we finally had a week with positive highs minus lows. In other words, more stocks in aggregate over the course of the past, well, we're looking 5 days here. So again, just to remind everyone, markets were closed Monday, so we're looking at Tuesday through Friday's data, and then we're actually including last Friday's data. So it's a full 5 days. But over the last 5 days, there have been 166 net stocks making new 52-week highs, which is the first time I think we've seen that this year. In fact, I'd have to double check that statement, but I believe over a 5-day stretch, we're finally starting to see more stocks hit 52-week highs. A lot of those stocks are energy defensive, so they're not necessarily tech or industrials or financials, but they are still less new highs being made, less new lows being made, more new highs being made, and we're starting to get this positive number. So that's notable. That's important. We want to keep an eye on that and see if that can continue. If we take a look at sectors here, it's a pretty negative week, all things considered. Basically, energy and industrials at the top of the list, the only two that were hanging around in the green spot. We did see consumer discretionary down only 0.5%. On the downside, though, healthcare and real estate financials, those were the biggest losers this week, 2 to 3% lower. And you can see most sectors still negative on the past 1 month, but we got a few here that are standing out and trying to go green. If we look at correlations, it still looks like a high volatility environment, right? A bear market. It still looks like things are moving very risk on, risk off. We've got a lot of bright green up here in the top left. So basically showing us that all of our indices are moving in lockstep with one another. We're still seeing those negative inverse correlations with the dollar. This is why we track the dollar. This is why we care about what the dollar's doing, because it impacts everything else, right? It is the big pendulum that sort of swings and markets react to. We also are seeing, pretty good inverse correlation here to TLT. So that is, more of the same for correlations, frankly. These are only 10-day correlations, but these correlations have really kind of stayed pretty consistent here over the past couple of months. You can even see Bitcoin is trading pretty in lockstep here with financial markets, with equity markets. You can see Bitcoin and the Nasdaq, or Bitcoin and S&P 500 running at about a 0.72 correlation. If we take a look at Treasury yields here, you can see it was a pretty ugly week. Because we did see a flare up here in interest rates. We're back up to 2.95 here in the 10-year. So we jumped pretty aggressively, and this is certainly not a good thing for the market. This is one of the themes we talked about last week. If you're bullish on equities, you really want to see rates stabilize. You don't want to see yields continue to blow out to the upside, and that's certainly what helped derail the stock market this week, right? Why we couldn't get a follow-through week in buying because of things like this. So we have Treasury yields continuing to rally here. They're not at new highs yet, but it's something we want to pay attention to. Basically, here's the way I'm looking at this. We'll talk more about this in part 2. We want to see a lower high get put into place here for the U.S. Treasury markets. That's what we're looking for. We're getting a rally going now. We want to see a lower high here, and then, ultimately the start of a more continued sustained downtrend. That's going to be your best bet for the stock market in general. We'll talk more about that in part 2. Last but not least, if we look at dollar and commodity performance here, you can see crude oil breaking out to new 52-week highs, new multi-year highs, 4.7% to the upside. We did see the dollar pick back up. It got pretty beat up the last couple of weeks, but it did rebound this week. Gold, nothing much. Silver, nothing much. Natural gas, not really a whole lot going on in the other commodity complex. Bitcoin was down 6%. Bitcoin's down 25% over the past month, so it's having a pretty tough time, sustaining itself right at these levels. But generally speaking here, dollar up, commodities sort of flat to down. All right, and last but not least here, money where my mouth is, our two trading systems we run, Merlin, Lamerick. These are both publicly available subscription-based trading systems that you can test drive yourself. But our top trading system here, Merlin, long only, multi-week swing trading system, still doing pretty much nothing. Very, very distant from the market right here. It is getting interested. It's getting a little bit closer to maybe pulling the trigger on some new long equities, but it's not quite there yet. So still just kind of hanging out, holding the yellow shiny metal of gold, and that's all it's doing. Our short-term trading system's been all over the place. Had some fun shorting this week in financials mostly, and had a couple of good trades that it locked in there. It is going into the weekend 41% net short. It is going to be covering some of those shorts, I know, on the open Monday. I don't know what else it has planned, but it has been enjoying this volatility and had a pretty good run over the past couple of weeks. So that's our current positioning there. Like I say, dollar trials available. If you're struggling, if you need some help, if you just need change of pace for your trading systems, check them out. See if they can help you, fully quantitative, run without my decision making, and very, very objective. So that's it for part 1. We'll be back here in just a second with some charts. All right, we're back here. We've got TC 2000 open, and we are going to look at some price action analysis on the S&P 500. This is the cash settled market, and this is the roadmap we've been looking at here. This is our high level kind of simplified roadmap that we've been analyzing for the past couple of months here. And what we can see is the S&P 500 starting to consolidate here, pretty neatly organized and tight. Now, tight is a relative measure because we are swinging up and down about 2% on all of these trading sessions here this week. But generally speaking, all of this action is taking place in the same area here. So we're essentially getting lots of inside bars, some outside bars, but just a lot of overlapping bars in this trading range. range. This trading range is taking place at a very significant spot. So if we zoom out here, this is the old sort of breakdown level back from early May, this 4180 to 4200 zone. This is what we looked up here as being pretty significant support. And when we broke down from it back in early May, we sort of said all bets are off on what could happen to the downside. We did get some good downside expansion, but we ended up stabilizing just underneath 4,000, just underneath 3,900. And since then, again, we are in this 9% rally off of the lows. And the market here is really digesting a lot of different things. And it's certainly digesting that bearish sentiment. It's certainly digesting some of those negative headlines that we see out of Tesla, out of Microsoft, out of many companies that are laying off employees or guiding down or being conservative and worried. That's what the market is grappling with. And that's, you know, arguably what the market has been pricing in for the past several months. So when I'm looking at this range now, this is what I'm paying very, very close attention to going into next week, because I think this consolidation that is occurring at a very significant spot is the key to sort of the next directional and what I would consider even potentially persistent or violent move on the breakout. And that breakout is, you know, I'm going to keep an open mind here. The primary trend is still down. The counter trend is up. And we are, you know, testing all of this overhead supply here. But what I'll be watching very closely is whether or not the market can start getting back over 41.75 or so, let's say Thursday's highs. If the market can take Friday's inside day, so we printed this inside session on Friday, if we can start to lift up here and break out over 41.80, I think there can be a pretty violent squeeze, almost as fast as we rallied up here, this 10% move. I don't know if we can get another 10%, but I would say that if we can start clearing above here, I think the squeeze could be pretty quick up to 4,300 or so. And I think the market would then start to deal with some of this resistance that we had back in April or so. But that move to me could occur pretty quick and is a very reasonable scenario here as we sort of scenario plan the week ahead. There's a lot of bearish sentiment. There's a lot of people that hate this market. There's a lot of people that just want to short this dead cat bounce. I mean, that is pretty much what you see in lots and lots of places. And look, that might be absolutely right. And so I'm going to just keep an open mind and say that if we start to break out above here, then I want to be playing for that move, taking off hedges, maybe getting longer, you know, whatever the case is, everybody's going to be different. If we don't see that happen, and if we see the market roll over, then we have a clear signal, and that is a move back underneath 40.70, approximately Thursday's lows. If we break down from here and we start losing, you know, this pivot, this support area right in here, the bottom end of this range, then yes, we will absolutely be looking to hedge, to short back for a move back down towards these lows, to play defensive if the market resolves lower. So that is what I'm going to be paying attention to. And the beautiful part is all markets are shaping out basically in the same way. The Nasdaq 100, same thing, 4 days, very tight and sideways. Russell 2000, same thing, 4 days, very tight and sideways. A little more optimistic with this look. But again, take a look at the placement here, just as it's bumping its head against all this overhead supply and at a very critical spot. So all of this, to me, feels like a bit of a gift from the market. We could get some fake out moves. This move does remind me, if I go back to the Nasdaq 100, it sort of reminds me of this move in here come mid-April. So this move, we were very violent sideways, tight trading for basically 7 trading sessions. So maybe the start of next week, you know, we could get another bar or two inside this range. This ultimately resolved down. The consolidation was also already in the context of coming down. So there's, you know, a slightly different character of how this formed. But this range here, which paved the way to the next sort of directional move down, is kind of what I'm looking at in terms of scenarios here, in terms of being relevant, breaking up or breaking down, and forecasting the next move. So that's what I'm watching. That's what I think is most relevant. We could get some other clues, right? We've got the VIX, which we could pay attention to, which is, again, been pretty heavy here. It's been a little bit without a bid. You can see this is below 25 or trading around 25 right now, and this is at 1 month lows. If you take a look at VVIX, this is the volatility of volatility here. Take a look at this. This is interesting, and I don't spend a whole lot of time, staring and analyzing at these markets, and there's probably some other, rational reasoning here on why this demand has really fallen off a cliff. But VVIX is actually making new multi-year lows here. Now, this isn't like a tradable instrument that you're going to really be doing any type of sophisticated, TA on. But what this is effectively telling you just at a high level is the demand, or is the interest, the demand for protection is shrinking here, is sort of falling off the cliff. So maybe people are hedged enough, right? Maybe they've already done their selling, right? Maybe this speaks to complacency on the other side of things. So it's an interesting note. Again, if you have more insights on the VVIX, if you're a vol trader and you want to leave a comment below and sort of share your thoughts and analysis on this particular chart, why, the rationale behind this happening here, I would certainly love to hear it, and certainly love to inform and educate others that are watching the show. But VVIX, very, very interesting. And of course, if we look at just, again, interest rates, I think this can be a nice tell next week. If we, scream higher here to start off the week, if we see interest rates just on this tear up, then I would probably lean to the fact that this consolidation we just looked at is more so going to break down. If we start the week off and we see yields backing off and we see this rejecting back down, putting in that lower high, then I would be more inclined to think that we do get a second push up here for the S&P 500. So we can keep that in mind. You could look at TLT as well. I mean, this is all tied in. This is just a long bond. But regardless here, I think Treasury markets will be interesting next week as sort of a clue in terms of that and volatility. And then just in terms of other charts now, leaving the market range talk behind us. If we just look at commodity oil here, you can see just breaking out to new highs and setting new multi-week highs. This is, in fact, I think oil is up now, 8 days in a row, 10 trading days in a row, basically. Some of those days were almost flat days, but still, it's just been grinding higher here and now marching up to new highs. So, inflation probably, still here to stay if considering energy is very big weighting in most of those measurements. And I think that is everything I wanted to talk about. I did want to mention Tesla, which we talked about at the top of the show here. You can see it's down 9%, really sort of sinking down some of the averages and putting a lot of that pressure into the end of the week here. So high volume and, moving back down towards, not at lows, but certainly kind of pulling back here, going back down towards those May lows. And then we also had that Microsoft move we talked about. This was where that announcement started the day around 263. We got them all the way back up to 274, and then it kind of gave some back here into the end of the week as well. So let's look at some of the sector and industry analysis here, and let's call it a day. After that, there's not a whole lot going on this week in terms of our two scans here. We've got business equipment, which is lifting up and ignoring the downtrend this week in stocks, up 1.5%, trying to lift up. This looks good. If we look at basic materials, lumber and wood production, also kind of bucking the trend, high volume, starting to lift up. And then we got shipping and ports, new highs here, new closing multi-year highs, which is very constructive to see. On the downside, we got healthcare plans specifically breaking down and closing at new multi-week lows. We see home furnishing and fixtures, very, very heavy volume here. So it's been in a downtrend. We're just seeing extreme volume back towards the middle of that range. And then last but not least, medical distribution. You can see new multi-week lows here in the context of a pretty strong uptrend though, and some decent relative strength this year, but certainly just continues to pull back and consolidate in the near term. So that's it. That's what I got for this week. And lots to certainly talk about, to think about, but those short-term levels in the S&P and the Nasdaq, that's what I'm going to be paying attention to next week. So that's what I've got. Leave a comment below. Let me know what you're looking at. What do you think about this market? Are you pessimistic on it? Or do you see that we might be able to get a leg up here or could break out on the indices? Leave a comment below. Let me know what your thoughts are. And as always, I want to thank you for tuning in every Friday. Long form market analysis, in depth, just like this. Subscribe on YouTube or catch us at thetraderisk.com. Have yourself a great weekend. We'll see you back here next week.